and 3-7, you'll take them out of your book and put them to where the RSI chart is at the top with the prices marked on it, and the RSI chart at the bottom with the 2 moving averages marked on it. We had gone through with the bond chart a major move to the upside, and in this case with the September dollar chart of last year, we had a major move to the downside, but it could have been a weekly chart, it could have been an hourly chart. We will not have the time to go through every single chart, but I want to cover a couple of them that are rather significant, that had so many different signals showing up on them that we're able to see all types of examples of all different types of patterns. What we went through earlier with signal counts and positive and negative reversals and bull and bear divergences, the recommendation I made about getting a triangle and studying with a triangle, I marked them up in a way in which you should look at all the charts in the book in this section, because I have marked them in a way in which you will be able to do exactly what we did with the bond chart for markets that appear to be in uptrends, going down your checklist, that basic 5-point checklist. If you knew nothing beyond that, you'd be able to see all the things that we had talked about with the patterns and do your math. And I cannot, even in one day, I think, cover all the types of patterns that you will see, but the idea of the signal count and the bull and bear divergences and positive and negative reversals, you will see signal counts sometimes that extend beyond 5 periods to 6, 7, sometimes 10, 11, 12 days. The example we went through with the bond chart, that longer term positive, although it was not a classic textbook definition where it was 5 periods apart, the one that was at 101 and then 107, the fact that you saw the range analysis and were able to apply everything to that kept you in focus and in tune with the trend. While the inverse, when you see markets that look like they're in downtrends, you're just going to go to your downtrend checklist and watch for 60-20, watch for your moving averages to be negative, watch for bullish divergence to set up, watch for what were what were support levels become resistance, or what were bottoms become tops, and watch for bottom tops resistance and bottom top negative reversals. But again, being focused and picking your points to get in will be determined by how far apart the signals are, how strong the signals should be, what your risk tolerance will be, and really what you want to achieve from it. Because once you identify a point that should be a significant turning point in a market, some traders, I have many short-term traders who are trading basically hourly charts that are clients of ours, to where they want to know what my perspective is on a daily chart over the next 2 or 3 weeks. If I am looking at a point that I think is an intermediate positive or an intermediate negative, and we should see, in the case of a positive, most of the activity be up on the upside, then they will be looking at their shorter term, their hourly charts, and 30 or 15 minutes, and be buying dips. Another thing you must consider is when you are looking at, in this case, a daily chart, as I said earlier, in the basic market structure section, always keep an eye and a perspective of what the 1 degree longer time frame is than you're trading at. So if this is a daily chart, I look at the daily and then also look at the weekly, and I go 1 degree shorter to see what the short term, so I can see what the short term trend is doing, what the longer term influence is going to be doing, so that when I'm looking at my daily chart, I'm going to look at a daily chart and say, we're here on daily, where's the weekly? And if I want to get a real short term perspective, where's the hourly? If you're an hourly trader you look at the daily chart and then maybe drop to 15 minutes. If you're trading less than an hour, if you're trading 5 minute, you look at the 15 or the 30 or the hour chart. But even if you're trading less than an hour, you might just want to keep a perspective on what the weekly charts are. Because if you look at a weekly chart in the case of that bond that we went through before, every time it came back down to the 40 level, see where the weekly was to see how far oversold it was. Was the weekly coming down? Was the daily down there? Was the hourly down there? And if they're all oversold at the same level, then the move should be more significant to the upside. If the daily was down to the 40 level, but the weekly had been up to 80 and was only down to 60, then you say, well, there's going to be a little bounce, but we're still within the uptrend. But if the weekly, the daily are both down around 40, then you're oversold on an intermediate basis and a long-term basis. These two charts here, 3.5 or 3.6 and 3.7, show a dollar index, September dollar index. And if you look along line A, you will see 0.1, 93.44, and right after that, like 2 periods after that, a 93.69 along line A, which had a little divergence. Prior to that, those 2 points where the peak in the RSI is right under the letter S for RSI, and the second point was right under the number 4 of RSI 14. That was also a divergence, but I couldn't squeeze it all up in there. The divergence that showed up there was followed by the divergence along line A, and the prices at 344 versus 369 were, it was a 3-period signal, 3 or 4 period signal, but it showed up a little bit below the 4 on the 14, the RSI 14, right below that. So it was somewhat of a hidden signal. I had mentioned hidden signals before to where the divergence doesn't necessarily stand out. So you might consider making a note, just drawing a little line under the letter S where the RSI peaked there, and also under the 4, or just below the 4, to show one divergence followed by another divergence. So it's like a double divergence, but the second one showed up a little bit lower. You also notice that it's right around the 60 level, and after that 93.69 close along line A, it dropped down to 92.38, then rallied back up to 93.64, which was right after 2 on that rally to what I had marked number 3. But look at where your moving averages are starting to turn down also. They're starting to turn down on the RSI. A lot of people asked, how can you quickly assess whether a divergence is going to be a good one or not? The moving averages are starting to roll over and turn down, that it's starting to show more intermediate type weakness. From point 3, you sell off again and then rally back to point 4 at 93.07. Another sell off and then a rally back to point 5 at 92.69. You look where point 5 is, points 4 and 5 on your moving average chart. The RSI had rallied right back into a declining 9-period moving average. So you can use your SMA 9 for support and resistance levels as a further input. But after 5, you sell off to point 6, and you get a rally from 6 up to 7 that crossed above the 45-day moving average at the bottom of the chart. But look at point 7 and point 4. You've got a negative reversal showing again. 92.84 versus 93.07. Negative reversal. The moving averages at the bottom, the 9 was coming up and got barely above the 45, but when it turned down, and then turned down. But 0.7 against 0.4 is starting to show as a negative. 92.84 at 0.7 versus 0.4 at 93.07. The price was lower, RSI was higher. The difference of 23 points, suggesting, okay, it looks as if we've got a negative. We're setting up or rallying, but we're only able to rally back to, excuse me, back near the 60 level. And it started to fall off again. And when it started to fall off again, you look at the moving averages at the bottom. The 9 barely, as I said, got above 45 before it rolled over and started down. You get down for a couple days, and then you get another rally to 92.03. Another sell-off, a rally back to 91.41, which is 0.8. A sell-off to 0.9, 90.56. And you look at 0.9 versus 0.6 and say, well, we're starting, maybe there's a little double bottom there in the RSI, maybe there's a little double bottom in price, because the price differences between 0.6 and 0.9 are not that great. So you say, well, maybe there's some double bottom support and the market's going to hold and turn higher. Well, it held and turned higher, but if you look at that 91.41 versus the 91.41 is your 0.8 and 0.10 is 91.33. You've got another negative reversal. In this case, it's only 2 or 3 days apart, 2 or 3 periods apart. You look at the chart on the bottom with the moving averages, and where I had marked 0.8 right along that first day of May, where that dotted line is, it should actually be a little bit lower, because you can see where the arrow is at the top of the chart that references 91.41. It's that little blip up the first trading day of May. So down on your chart at the bottom, you might want to put that 8 down below the moving average. It was actually below it, not above it. But that was a 3-period negative. And even though it was only 8 points apart, it's still a negative. It's a classic 2 to 5 period negative signal. You look at your moving averages, they have crossed to the downside, and at 0.10, the rally had been back. It was trying to rally back up into the 45, which it never got to. But I drew a little line in there, that line D, to show you that the RSI was higher, yet the price was lower. So you get a negative that shows up more with points 4 and 7 that's outside the optimal 2 to 5, which is along line B. 0.7, even though I had drawn that line C in there to show you that it was higher than 0.5, but the negative after that was 0.4 and 7, suggesting lower prices. You get another one at points 8 and 10 that's only a couple days apart. So when we had questioned whether or not 6 and 9 are going to be a double bottom in price and a double bottom in RSI, you say, well, maybe, but let the chart show me. Well, if it's going to be a double bottom and you're going to see a negative reversal and you're going to look at your moving averages, and now we're not even getting back up to the 50 level. The first negative we started to see at 0.7 was up near 60. Now this one is near less than 50. The moving averages are negative. I don't think you have to question at that point whether or not that double bottom is going to hold in price. because of the fact that you've got a moving average and you have a negative reversal with points 8 and 10, and the moving averages are pointing down. Your support at 90.56.9 and 90.68.6 should definitely be broken. Now, if we do just the math on it, you hit a bearish divergence at 1 and 3. You had a 2 to 5 period bearish divergence at points 1 and 3. And I also pointed out we had one before, but let's just work off a line A. Line A says bearish divergence. You sell off to number 2, a rally back to number 3, which failed to make a new high. Sells off, comes back to number 4 at 93.07. You sell off to 6. You come back up to where the peak was at number 7. That's your first negative after a bearish divergence. Remember I said bearish divergence is an uptrend until you see a negative which confirms the bearish divergence is real. Be the inverse on the bullish divergence side. We saw a bullish divergence and the market would continue to make it until you saw it followed by a negative. Everyone always asked, how soon after a bearish divergence should you see a negative? To me, the question is not how soon after. The question is I better be aware every time I see a bearish divergence, be alert to the fact that it could be a final divergence. But I have to see a negative to confirm it. If it happens very quickly after, I would say that you could anticipate a rather big move because of the fact that it's showing a lot of weakness very quickly. If it takes longer, your market may be sideways for a while until it does start to break, and then when it breaks and you get that negative, you should get one following another, following another. The first negative that you see with 4 and 7 confirms the bearish divergence. The second negative you see with points 8 and 10, the second negative confirms the first negative is real because you're getting back-to-back negatives. Just one point about options for those that trade options. When you see negative reversals, you should be looking at purchasing put options. When you see positive reversals, you should look to purchase your call options. But when you see a bearish divergence, in the case of the put options first, when you see a bearish divergence, the put premiums are going to be a certain price. When you see the negative reversal, the put premiums will probably drop because up at 1 and 3 along line A, everybody still thinks the price is going to go up. So the put premiums or put options are priced at a certain level. When the market starts to drop off from points 3 and 4 all the way down to 6, the price of the options, the put options, will go up because everybody sees the market going down and they want to be hedged. When you rally from 6 to 7, most people are wiping their brow, breathing a sigh of relief, say, gosh, I'm glad that correction's over. It's an all clear sign. We're going back up. The put premiums, or the cost of the puts, when you see the market move from 6 to 7, will start dropping because everybody thinks the worst is over. So as those put premiums start dropping and you set up for a negative reversal, you're going to be able to get more bang for your buck. But they will have another sell-off. In the case of here, 4 and 7 showed that one negative, and it dropped from 7 down to 9, and then it rallied again up to point 10 and showed a little 2 to 5 period negative. So the negative at 8 and 10 is your second negative, confirming your first negative with 4 and 7, which confirmed the bearish divergence is probably real, telling you that the trend is probably definitely going to start moving lower, but also the fact that you're getting the shorter term 2 to 5, and we were talking about it's the most dynamic, the 2 to 5 period. So at point 10, your trend analysis decision is being confirmed because that's the second negative. If you do simple math, again, I said if you can add or subtract, you can trade futures. 92.84 and the 93.07, that 23 points difference. 0.6 was our support level because that's where the last support held before it turned up and created the negative. Take the 90.68, subtract 23 points, and you're going to 90.45. Well, when it sold off from 7 down to 9, hit 90.56, didn't achieve the 90.45 on close, right? But the rally that took place took it right back up into another negative of 8 points difference that said our last support now is 0.9, 90.56. Our last negative was 8 and 10. The difference was 8 points. Take the 8 points off of 90.56. It sets a target of 9048. Now you've got two different negatives pointing to 91 points to 90.45. The one we did was points 4 and 7, subtracting that difference off of the 0.6 at 90.68 to get 90.45. Now we're taking points 8 and 10, subtracting those difference, the difference in those 2 points from 90.56, suggesting 90.48. So we have 90.45 and 90.48 as objectives. If you're buying options, you're setting a target at that level. If it's a solid negative and you look at your moving averages, they've already crossed. If it's a solid negative, that target should be achieved and surpassed to confirm that the market is still in the downtrend. So you say negatives are pointing to the downside. The bearish divergence is now being confirmed by back-to-back negatives. We should go to a minimum 90.45, and your moving averages are down, saying we should just stay on the short side. The trend is reversed. This is why when you look at the bearish divergence, I say use bearish divergence to take your profits. Because if you look along line A and you had been long, you say, well, I better take partial profits. If you take your partial profits, then you start to see the market sell off. Look at your moving average. They're turning down. The rally from 2 to 3, it rallied up and immediately turned down after a quick maybe a 2 or 3 day rally. Turned down, came back up to 4, down, and then when you went and created that negative with 4 and 7, if you are long in an uptrend and you see a divergence and see a negative, the first thing you should worry about is getting out. You want to take profits at bearish divergence, but if you see a bearish divergence followed by a negative and you're long, don't worry about where you're going to sell first. Worry about getting out of your longs first. Just get out of the market so you're flat, and then say, I better take a look at this because it may be changing and I don't want to be caught long because we may start seeing negatives. So when you see that rally back up to 7 and you're looking at resistance above it at 93.07, 93.64, 93.69, you're saying there's a lot of resistance above it. It could be a negative reversal pattern. The moving averages have crossed to the downside. Let me get out of my longs and look for a place to sell. You can sell like we had talked about before. You don't know if it's a negative, but you do know it could possibly be. You know where your resistance is, so when you see 0.7, you can do one of two things. Put the order below the low of that day, catch it on the way down, selling the next day, or expect to see a rally above 92.84, and watch and see whether it goes above what your negative reversal point is, 93.07. Put an order in, close or better. Put a stop above the 07, 93.07, or a stop above the 93.64. And again, it comes back to how aggressive do you want to be? Do you want to go close it better, 92.84 or higher the next day? Do you want to try and pick a point like 93.07? Did you do your range analysis from, say, point 3, 93.69, your high close down to 90.68? Do your range, divide by 8, see what the retracements are on the way back up? See what the 50%, in this case the 50% was a 300-point drop, a 50% rally would have taken you to 92.18. You went above that. Did it go 75%? Wherever it went. See where the retracement should be and anticipate the fact that it may fail up there because your moving averages had started to turn down. See where your SMA 3 is. Remember we had talked about time cycles. How many weeks is it over from a low or from a high? But the important thing is when you see 4 and 7, you say that could be a negative. I've got to get out of my longs because things are changing. Because on your uptrend checklist, you should see bearish divergence on your uptrend checklist. But you don't see negative reversals on your uptrend checklist. You see negative reversals on your downtrend checklist. If a negative is showing up in an uptrend, then you have to say, I must have missed something, and go back and look and see if there was a bearish divergence, which might have been a 2 to 5 period. And also the fact that get me the hell out because of the fact if it is changing, I want to be on the other side. I'm on the wrong side of the market. From 7, when it sold off, we were looking for that double bottom. If you want to be, again, a conservative, wait for the market to start down from 7 and say it does look like it could be a negative. Let it sell off a little bit. Let it rally back and sell again or sell off again to where give it a couple days, a week. There's no hurry if you want to be ultra conservative, but recognize that since you have seen a negative, it could be changed. Things could have changed. When you get the little 8 to 5, or excuse me, 8 and 10 points, 8 and 10 is showing as a negative. It's another negative confirming the first one. And we had talked about this double bottom possibility, but we've got two objectives under that price level. So we know we should go to at least 90.45. Well, if you want to go in on the second negative, look at the 91.33, that rally. Try and sell 91.41. Or if 90.56 is your support level on close, put an order in as a sell stop. Or the day after point 10, when you see the 90.33, the following day, watch the market, see if it opens higher, trades up and starts to sell off during the day and sell on close, and put a stop above either point 8 at 91.41 or up above 92.03, which was your last rally point. And then expect to see the market go down and take out the support at point 6 and 9 because your objective is below there. It does go down to point 11 and takes out that 90.45 and kept going to point 11's low where it made a momentum low and then another rally back up. When markets get oversold, they rally. If you were short and aggressive because you had been long for a while and you saw the bearish divergence up at line A, even if you didn't get out there, but you had totally reversed the position, went from long to short, on the rally up into 7, if you were already short and you see something like a new momentum low at point 11, say, well, we had an objective under 90.45. It went 200 points under that. It achieved and surpassed your downside target off your negatives. But when it started to rally back up, take partial profits at point 11. Say, well, we've achieved it. The RSI made a low. Now it's starting to come back up. Take partial profits and then start going back into your price cycle or price range analysis. See how far back up it should rally. At point 11, you know 90.45 and 90.48 were negative reversal targets on the downside. it blew through those on the way down. That was support. 90.56 and 90.68 was support levels. What was support should become resistance if we have negative reversal showing and we're in a downtrend. When you see a rally that takes place and it got all the way back up to 12, point 12 shows you two things. One, it's meeting resistance at 90.56.9 and 90.68, and then do your price cycle analysis to see the 50%. Look at point 12 on your bar chart, on your moving average chart on the bottom. The moving averages are still down. That's topping out at 50. Point 12 is another negative with point 10. It was probably about maybe 12, 13 trading days apart. But 91.33 at point 10 and 90.38 at point 12 is almost 100 points. So if it's a 100-point negative, it's going to tell you that your next target is 95 points, 87.52. So you're setting objectives that are lower and lower and lower, and you're seeing bottom top negatives. You're seeing moving averages down. You want to see, by this time your moving averages on close should be down. You get another negative that goes down, and it works its way down into point 13, which creates 11 and 13 create more of an intermediate type bullish divergence, which comes in a downtrend. So you've got negative reversals. Now you've got bullish divergence showing up with point 13 versus point 11. You had that target of 87.52, which is achieved by making another momentum low and a new low price, creating this divergence of line E. But right after that, you get a rally to 87.18, one-day pullback, and another rally to point 14. But it's 87.18 versus 87.11. It's another negative reversal. When you start seeing one right after the other, bing, 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 then it's just more and more confirmation. But you got the one at points 4 and 7, another one at points 8 and 10, another one at points 10 and 12. Bottom top resistance at 6.6 and 0.9, which held at point 12. A bullish divergence, another negative. The moving averages on the bottom chart are still down. So as long as you're seeing the negative reversal patterns, the trend is down. But you should see a bear divergence followed by a negative. If it's a positive reversal, we would have seen a bullish divergence followed by a positive. But this bullish divergence said, okay, a bullish divergence, the market's going to turn up. Look where it is, below 30 at point 13. How low can negative reversal patterns come? Well, this one came in at about a 35. And people say it can't go any lower because the RSI is already below 30. Well, this price at 13 was 86.70. Then you made an 84.50, and then you went below 20 at 83.14. So it can really get moving and get moving in a hurry. And even when you rally from a momentum low at 15 all the way up to 84.05, you got up to about the 45 level. But I put a little star in there because the first rally attempt was 84.39. Right after point 15, the market rallied sharply. 84.39, sold off back below the 30 level. Rallied again, 83.48, little 2-day or 3-day pullback. Another rally attempt, 84.05. You're still making lower prices and higher RSI values. You're still staying below 50. You're moving averages, even though they had turned up. You say, well, we might have a short-term bottom. Look at point 15 and point 16 and draw yourself a line connecting those two. You have a bullish divergence showing up. but bullish divergence comes in downtrends. I would love to be able to spend an hour on each chart, but we don't have that luxury in trying to cover everything. Remember also, when we had done them with the bar charts, if you want to see a bar chart below it, take the same chart, put a bar chart below it, and draw your horizontal lines based on your negative reversal points at the key points on, the key points when you get the negatives, like 8 and 10, or 4 and 7. Point 7, find that appropriate point on your bar chart and draw a negative reversal line. Just a horizontal line on your bar chart. Points 8 and 10, another one at 12, another one at 17. Could have drawn one at 14, and you would have seen where the bars were dropping. The bars were dropping down with price, and these lines were coming down behind the bar. (3-8) is a chart we had talked about before. When we were taking a break, some people had jumped ahead and asked about it. But I think it's one that we had discussed earlier in a different context about positive reversals on the trend analysis section and range analysis. And we had talked about, I believe it was points 11 and points 13 on one of the charts previously, where we had marked just, we were looking at just range. But you see points 1 and 2 on the RSI chart at the top. Slightly higher RSI, slightly lower closing price. Points 1 and 2. And then we had a rally up to the 60 level and a pullback to number 4 at 332.5, which came right back to the 40, and I had connected that line A in there. If you extended it back, I think it would have been right under or right through the point 1. But point 1 and 2 was a little bullish divergence. Then points 2 and 4 were a bullish divergence that were well outside the 2 to 5 optimal time period, as were 1 and 2. But when it started to rally from point 4, rallied, broke up above 60, pulled back for a day, rallied for a day, and dropped off for 2 days. But look at points 6 and 7 with a positive reversal. Positive reversal pattern, which means we should get a rally to new highs. We did. Another pullback where I put in the basis of line C. Point 9 was the first touch point on that line C. 342.10. A rally, a pullback to 342.20, and another rally to 345, I believe it's 40, along line D. So we see another one of those patterns where it's a bearish divergence with a positive reversal built in. Then we went up and created more bearish divergence with 11 and 12, and we were approaching the 80 level, and I think we saw positives after number 12. We saw the pullback that created a few positives, and we rallied again above the 80, another bearish divergence with 13 and 14, another bearish divergence with 15 and 16. And like we had talked about on the bond chart, when you get those divergences up around the 80 level, it should just be a short-term momentum peak. But you're getting multiple divergences, which says it should sell off. Then you start figuring your 50% retracements from where your positives were, like numbers 9 and 10, and the move up from point 4, 332, up to 387. Figure your 50% retracement. But look where that line A, where I had drawn all the way across, it came straight in. If you had drawn your positive reversal points and even your top-bottom support at points 11 and 12 where you created divergence, you pulled back and stayed well above that level. So I can't emphasize enough that when you start seeing the positive reversals be long, view the trend as long, look for confirmation with moving averages, and use that SMA 3 in late March, in early to mid-April. You should have seen it in the lower part of the chart. And then in late April and late May, it should have been up above 80, helping you to say, or helping you to see that the market was indeed overextended and needed a good correction back to the downside. Now this one I didn't put with the moving averages, but it's pretty self-explanatory that you're seeing positive reversals, you're seeing bearish divergences, and you're seeing an RSI which had been holding at the 40 level in January, February, March, start to make higher levels, break 60, move up, create bearish divergence and complex patterns. And your moving averages of RSI, the 9 should have been way above the 45, and on close the 9 was above the 45, so you had the confirmation of it. Chart 3.9 is an example of a weekly chart that shows, if you notice the markings, a lot of bearish divergences. It started off way back in May, June of 90. Lower left-hand corner, you'll see 5084 with an arrow pointing to the bottom, and then 5010, 5084 and 5010 showed as a little 2 to 5 period bullish divergence. The rally up to 3 and then up to number 4 stayed below the prices that were made to the left of that. The closes at 54.75 and 55.62. But when it pulled back from 4 into 0.5, look how it pulled back into the 40 level on the RSI. This is a weekly chart. Pulls into the 40 level, and then another rally to 53 to the right of that little, look like a backslash, 53.61 from 0.5, moving up the chart to 53.61 close. Look to the left, 53.52 and 53.85 were the two previous closes at points 3 and 4. But you started to see the RSI took out the 53.52, and it should have told you the next resistance was 53.85. It rallied up. After that, you had a little pullback to 53. After the 53.61, a little pullback to 53.13. Then a move to new highs in RSI and close. 54.74 takes out the resistance at 3 and 4. But we haven't taken out the resistance on the other side of it, but we're close to it because it was to the left of number 3 is 54.75, 55.62. But when we get the little pullback from 0.6 at 54.74, it sells off 53.59. Look to the left of point number 7 there. That would be 0.7, 53.59. Look to the left where that hash mark was, 53.61. Starting to see a little evidence of tops becoming bottoms. 53.61, now it finds support at 53.59. And this is a CompuTrack chart, which means it's probably out of the CSI database on their weekly charts, which is their perpetual contract, the one we had talked about, with being weighted, a little forward weighted. But you start to see evidence of this top-bottom support. Now, if this is a weekly chart, which is your longer-term perspective, and you're seeing top-bottom support, your daily should start to show you either some sort of top-bottom support or range analysis or moving averages turning, probably it turned up by then. But then it started to move up, got up to 8 and 9, created divergence, 59.36, 59.85. Little sell-off to 58.25. After 0.9, you sell off. A rally back from 0.9, 59.85, the sell-off to 58.25. And over the course of the next week or two, a rally to 58.89 and a pullback to 58.38. But look at the 58.38. Look to the left to see the 58.25. There's a weekly positive. Little 3-period positive on a weekly chart. If we're getting a positive, it says the market should turn. We see bearish divergence at 8 and 9. We're seeing a positive reversal. This is one without moving averages, but just the RSI is saying bearish divergence, positive reversal. Trend should be up. We then got another rally up to number 10, created another divergence with 9 and 10, also with 0.10 and 0.8, but then we sold off to 0.11 and created another positive at 58.83 versus 58.38 versus 58.25. So bearish divergence and positive reversals.